Welcome back to Deal Flow. Ryan right here as always. My guest is Nicholas. Nicholas, I didn't even ask you this. Do you go by Nick or Nicholas? I should ask you that. We talked before on the phone. I was like, man, what? I didn't even know. I should have known this.
I'm a pretty easygoing guy, and I don't like Nicky, but Nick or Nicholas are both fine.
You see, it's always confusing with people with names like Nicholas because if you spell it out like you do on Twitter or on your email, it's like, okay, does he want the Nicholas or is that just like the proper business term that you use? Because when I was younger, I had a son and his name is Ryan Andrew Ray Jr. We call him Drew. And so I was like 23, 24. I was running this company and I was meeting with all these older guys. So I called myself Ryan Ray Sr. So I would sound older when I was
That's
meeting.
pretty clever.
And then people are like, oh, there's no such thing as a senior. I'm like, whatever there is. So, anyways, okay, do a quick introduction for us, and then let's hop into all things deal flow.
Great. Yeah, my name is Nick McLean with Four Pillars Investors. Four Pillars Investors is a firm I founded with one other partner. His name's Thomas Sanford. We've completed about 7 transactions. I would say our portfolio at present is overweight in manufacturing, but I don't know if you're familiar with the Kansas City area. In Kansas City, you can't walk out your front door too far without running into a manufacturing firm. Going forward, we're generally industry agnostic. Really what we're looking for are companies that have what we call an untapped potential for growth. Whether that's an aversion to hire a sales team, whether that's the shortened the risk profile that doesn't want to make an investment that's going to take 3 to 5 years to earn a return, those types of things. Not to bore you, but my background was in industrial engineering, which is about making processes more efficient. And through that, I'd work really hard, and we'd save the company money. And then also, I worked in business development and landed one customer, and that customer alone increased revenues 20%.
Mm.
I'm just thinking, okay, what's worth it more? Like working really hard to save a few $100s, or landing a huge new customer account. And that has really stayed with us as we think about how we want to work with our portfolio companies.
It's interesting just to hear you talk about that because, and I don't want to spend a ton of time on Dave Ramsey. I think he's got a good place in our society, but his mentality, I think, has creeped into the business world just a hair, where it's far easier to grow the company, as you mentioned, to go get the right client, to grow yourself out of problems than it is to optimize, and maybe snowball your way by reducing, debt or expenditures or whatever. And so I do think that I do wonder, do you find that across a lot of businesses, they think if we can just lower costs, and there's definitely time for that. If we just lower costs, things would be better. Instead of going, you know what, if we can just get one, two, three clients, man, our life is so much better.
Yeah, I really, agree with what you're saying there. I mean, it is just a philosophical difference, and there are always going to be people that are I don't want to call them penny pinchers, but they're more focused on the dollars that go out of the door as opposed to the dollars that are coming in. And we're always of the mindset that if we can make a bigger pie, then everybody's piece is going to be bigger, as opposed to, well, the pie is staying the same. We're going to have to make sure that our piece is as large as possible.
Okay, so let's get out of some of the fancy terms and let's talk maybe a little bit more practical. So you, like on Twitter, it says you're lower middle market. Okay, so let's unpack what lower middle market means. People are probably familiar with private equity, but I talk to people all the time that don't know what private equity is. So let's unpack those two terms and we'll dig in a little bit deeper.
Yeah, absolutely. So, if you did a Google search for lower middle market, you're probably going to hear different size ranges than what I'm going to talk about. But when I think about lower middle market, really what I think about is EBITDA of, let's call it 2 to 15 million, and there's nothing scientific there. I'll tell you why I think about that is because most of the private equity firms that we work with that are quote unquote investing in lower middle market, that's their size parameters. So even though Google might say something else, my experience has just been that a lot of folks that call themselves lower middle market private equity investors are investing in that $2 to $15 million EBITDA range.
Yeah, it's funny because I was on a call somewhere earlier today, and I use the term SMB, and he goes, okay, and he goes, yeah, it's probably too small. I'm like, okay, I'm saying SMB. Okay, I talk to companies that are doing 50 million in revenue, and I'm calling them lower middle market. And he goes, oh, okay. It's funny because in the world where we kind of operate, everyone likes to use the jargon, but then you find out that the jargon is almost meaningless because no one, like everyone kind of defines it differently and they think about it differently. And it's like, it's so funny because I say it feels like at times we pride ourselves on using jargon. And then when you get down to it, most people don't even understand the jargon. And so it'd just be easier to say what you said.
Yeah, exactly. And I mean, it leads to confusion. I mean, like if you like in the business press, if you read something about like an SMB, I mean, it's probably going to be more consistent with the size that you were talking about. But in the M&A space, there's just this huge community around SMB M&A, and it's decidedly smaller than how I think the popular press would describe an SMB.
Hmm. Okay. So private equity. Let's talk. Maybe there's a lot of private equity models. And private equity gets bad press, good press, depends on who you talk to. Sometimes I talk to sellers and they're like, I don't want to work with private equity. Let's maybe unpack that. Why do you think, and this is also something I want to unpack here. If I said I have a private equity client, they're thinking like I'm working for Redalio or something like that. And there's a ton of private equity that no one's ever heard of that are doing a lot of deals. So why do you think private equity maybe has a bad reputation? Is that earned by some of the bigger companies, small companies? And then how are you guys doing things differently?
Yeah, absolutely. I mean, I would say that we have personal experience working with what I would call quote unquote bad private equity. So without getting into the details, we were up against a private equity firm on a deal. We lost out to this other private equity firm, and literally within a year to 2 years, this company is struggling because of how poorly it was run by the private equity firm that bought it. It's the I'm not trying to disparage East Coasters and in particular New Yorkers, but if you have any negative thoughts about the typical New York private equity investor, it might be that type. And so those stories, whenever you hear them, they spread like wildfire because they're such a cautionary tale, if you will. And so that's part of the reason why I think private equity gets such a bad rap. Additionally, and this kind of is a good segue into how we're different. I think a lot when you look at private equity firms, a lot of the folks within the firms have a purely finance background. Investment banking, working at some other private equity firm, and this and that. And what I will tell you is my experience is that a lot of private equity firms are are, are spreadsheet driven. They'll create these beautiful financial models that have 1,000 different levers you can pull to change the outputs, and they'll have these sensitivity analyses that will they're so complex. Even though they have the latest processors and all the RAM and all that, they'll still like stop their computer from working because they're so complex. I tell you what, I mean, my partner and I are different. Like, unfortunately, we didn't go to Harvard or any of those schools. We didn't work in a bulge bracket firm in investment banking. But you know what we did do? We became a president or a CEO or whatever you want to call it of the type of business that we're trying to buy. And we know that day one post close, that fancy financial model, it's going in the trash. It's kind of like the analogy of war strategy or getting in a fight. Like, everything changes after you get punched in the nose or however you want to call it. And so that's why we're really different, is because we've been in the seat or in the shoes of the person that is selling their business for the actual types of business that we're trying to buy.
So from the lower middle market SMB owner, whatever you want to call them, president, CEO, what do you think makes the right type to sell to private equity versus the wrong type to sell to private equity?
Yeah, I mean, it's a good question, and I haven't really thought about that in great detail. However, there is one component that that I have thought about, and I would say that the number one component that I think makes a seller a great target for private equity is if they want the business to continue to grow post close, and they have an interest in the company doing so. Now, typically, we will want the seller to maintain some level of vested interest in the company post close. We get a little nervous when we hear a business owner say, "Man, this business is so great, just churns out dollars, and it's just the greatest thing ever. And oh, by the way, day one post close, you're never going to hear from me again. Don't call me. No contingent consideration, nothing like that." And we're kind of thinking, okay, if this is the greatest thing ever, then shouldn't you want to be a little bit involved to get some of that money? So anyway, as it relates to your question though, whenever we find a business owner that wants to take some chips off the table, or they've done the analysis and they know that they can double their business with this type of investment, but as a 60, 65, or 70, or however year old, or 55 even, they need to put their family first. They need to have a diversified investment portfolio, and dropping 5, 10, or however many dollars it might take to take EBITDA from 4 to 8 million. It's too risky for them at that particular point in their life. And that's why a partnership with private equity can be such a good decision, because they get to take some chips off the table, and at the same time they get to benefit from the continued growth of the company.
How hard is it to double a company's EBITDA?
Oh, I mean, that's just that, it depends. I mean, it's a really, really hard question. I mean, what I will tell you though is, this might sound trite, but in our experience, the companies that are the most likely to grow are the ones that have growth as a stated objective, and everyone knows that. One of the companies that we purchased out in Portland that my partner is running, the seller had really just gotten comfortable, didn't want the stress of adding square footage or new equipment or whatever, and he really felt safe. However, once we got into the situation, we realized that it wasn't safe, because his customers wanted their supplier to grow with them, and their supplier wasn't growing with them. And so when we look at situations like that, you ask, how easy is it to double? Well, if you got the capital in the space, it's pretty easy to double. However, we've also talked to business owners, and they say, yeah, we want somebody to help us with growth, because we've tried everything in the world, and we can't grow this thing. And so in those circumstances, it's like, well, unless we're going to do a buy and build strategy, which we do. I mean, I am a strong believer in. But in terms of organic, sometimes it can be difficult.
And the reason I ask that is because when I talk to prospective sellers, they're skeptical. Getting that second bite of the apple, if you will, like, oh man. And it's interesting because I've worked at, I think, the most we did at the last company I was at was like 7 million in top line revenue. But our EBITDA was kind of that 1 to 2 range. And so and we worked for a lot of big companies. And for us, we knew to grow, at least at the time when I was there, it would take a lot of capital investment to get over that hump, right? Because we could spend a ton of time. We're competing against a client that our competition had bigger pockets than we did. So for us to grow would take stuff that was not really what we wanted to do.
Mhm.
But the right lever, you could grow exponentially. But I think sellers share that. Private equity can come in, they're going to grow, and it's almost like, well, how come that hasn't happened? And so that's why I ask, how hard is it? Because there's a lot of factors involved, but sometimes it also is just the person running the company. To your point, like they're not really motivated to go. And I think that kind of gets lost in this discussion about why people sell their business and whatnot. Man, if you're making 3, 4, $600,000 a year running a company and your stress is pretty low, it is hard to get motivated to go that next level, because your margin might get reduced depending on what kind of business you're in.
Oh, Ryan, I mean, think about this situation though. I mean, think about, some entrepreneurs who didn't have much growing up, or I mean, even if they were a middle class family, I'm not talking about 3 or 4 or $600,000. I mean, some of these guys are making $3, $4 million a year. And
Sure.
so,
Right,
I mean, if
right,
you're making
exactly.
$3 or $4 million a year, I mean, how much different is it if you make 5 or 6? I mean, sure, come on. I mean, I mean, it's $1 million or $2. I mean, yes, that's a big deal, but still, I mean, at $3 or $4 million a year, you're going on any vacation you want.
Right.
I mean, you're going out to dinner anytime you want. All these little things. Like, how much does it really change your life? And I would argue, well, maybe it doesn't so much. And that's a big reason why I see them you'll pull back on the throttle in terms of trying to grow their business.
Yeah, I mean, obviously 3 million is a lot more than 600,000, but 600,000, depending on where you live in the country, that's a substantial number too. And
Oh
so
yeah, absolutely.
you're right though. You're right. You get to these numbers, and it's like, oh man, this is, things are going. I mean, I talked to a guy last year, and that's exactly what he said. He goes, we might want to sell, but our business is international. I can go anywhere I want on a business trip, and I can take all and company truck. He went through all this stuff. He goes, yeah, okay, yeah, we might want to sell, but what's the upside here?
Yeah. Yeah. I mean, if now if we're switching to that topic, I got a lot of stories there. I mean, I've talked to business owners where they're like, yeah, I don't want to sell because now all of a sudden, I'm whenever my wife asks me to do something, I'm not going to be able to say, oh, I got to go to the office and sign some checks or whatever. They're actually going to have to do those chores around the house, and they're like, hey, I'm not ready for that.
Mm. What do you think makes some of these businesses, the ones that you're looking to buy, right? So if I'm a small business owner or middle market owner or whatever, um, what makes them attractive to private equity? Is it just clean books? Is it good operation? Then they need like AOS? Like what are the key things that you guys are looking for? Obviously, they got to have the revenue range, but aside from that, what are secondary things that you go, yeah, this makes us make us really interested in your company?
Well, I mean, always the starting point is growth potential. Is this the type of thing where 1,000 stars have to align in order to achieve growth, or is this the type of thing where, again, we talk about like the risk profile of the seller, or not trying to be disparaging to some sellers, but it's just a fact of the matter that given how businesses operate, sometimes it takes a certain person to get a business to 3, 4, 5 million of EBITDA, and it takes an entirely different person to get from 5 to 10. A lot of times what we see there is that it requires a focus on processes and procedures, in which some people might call bureaucracy. That is really anathema to the core of an entrepreneur. So I would say that growth is very attractive to us, and we're a little bit different. I would say as entrepreneurs, one thing we actually look for to some degree is a box that is currently not checked in terms of why this company would be attractive, that we feel like our experiences, skill set, network, et cetera, can check that box and therefore make the company more valuable. If you understand what I'm talking about there.
Yeah, yeah. So how do you guys think about, if Twitter's the world that we all live in, I think. So how do you guys think about determining where the crowd's going? Do you go with the crowd? Do you go away from the crowd? Do you kind of get on the edge of the crowd? How do you think about that? Because I find that on Twitter, especially, some of the conversations are like, okay, yeah, you can buy the service business, whatever, great. But man, there's a lot of other things there's a lot of other things to look at, but that's also the problem is there's so many businesses that it's really an endless pool of opportunities out there. So how do you figure out which way to swim with?
Well, I tell you what. I mean, I'm not going to go so far as to think I'm an idiot or a dummy, but I will tell you I'm not smart enough to pick where the wind is going to blow in terms of what's the next industry that's going to be hot. And I think one thing as you talk about Twitter that there kind of is a theme around is boring businesses, and that certainly is an interest of us. And when I think about boring, what I mean is not subject to the vagaries of public opinion and again which way the wind is blowing. We like companies that are thriving despite the fact that this other industry is super popular or whatever. And that's a big reason why we're industry agnostic, is because I mean, Ryan, I know that you've seen all these businesses and you're like, oh my gosh, I had no idea that people can make that much money doing that. Like that is so, I mean, that's what, that's part of what makes my job so interesting, is like just really seeing how people have been able to make a living. And it's for that reason that we just like to be open-minded and whatnot. And four pillars of investors, like the first pillar is relationships as a cornerstone for success. And that's really how our deals start. It's getting to know the seller and getting to know, like, why they like their business, what's excited about it, because that's how that's really how it starts for us, is getting to know the person and the business. And at that point, then we can decide how excited we are about it, not the latest trends on Twitter or whatever the case may be.
Yeah. It's interesting because the boring business is obviously the thing. And to your point, I like telling the story because it's just to me, I am an idiot. So you don't have to be one, but I am. I talked to an owner last year, and they made like the back of those UPS or DHL trucks, the little balls down there that the stuff rolls on. They made the balls that go in the back of that truck. It's little ball
Wow.
bearings, and that's what they did. Now they were really small. It's an older couple that owned it, and they had a partner, and I don't know what the upside potential was, but it was just like I didn't even know that was a business. I never would have
Yeah.
thought that someone just made those things to sell to the back of the trucks. Um, so if you're in business now, and this is something that we do hear from sellers, like we hear this a lot from new construction general contractors, right? They have a tough time right now exiting. Not a lot of interest in buying those. Um, what would be your advice to someone who's not in the boring business, but they do want to sell, they do want to work with private equity, they think there's a lot of value there. Should they go expand their, through acquisition, other industries to make them a little bit more boring, to make them more appealing, or how do they present themselves if they're not in that stream of the boring businesses right now?
I mean, it's a good question. I mean, let me talk about new construction, first, just because it's a tough one for me. On the one hand, you look at Kansas City, where I'm from, for example, like some of the most successful, wealthiest families are construction. You know, I mean, I've heard from numerous folks. It's like, yeah, the people in construction are the ones that are flying on the private jets, and not just private jets, the private helicopters. Like forget about jets, like we're going to fly on a helicopter. However, that is, I would say, where there's one drawback to private equity is because, as the private equity funds have a defined life, and even if you can string together 5 years of growth, a private equity firm is going to be, well, there's going to be a downturn soon. I can't take that risk. So I will say I unfortunately do not have a silver bullet there. However, I definitely have some thoughts. In terms of what's boring is creating the biggest new structure in your city exciting or boring? Well, I would probably say that's exciting. So what can you do to do more boring construction? Well, maybe that's more renovation work or this or that. you know Also, I think of construction as, generally speaking, the construction project is done, you shake hands, say this was great, thanks, and yeah, if I need to build another building, I'll give you a call. Well, what if there's a way to continue that relationship? Whether you say, I'm going to build this building for you, but I'm also going to maintain it, from maintenance and service contracts, or the only way that we'll build this building is if you allow us to be the property manager for this building. And I'm saying really stupid ideas right now, granted, but that's kind of how I would that's how the thought process that I would follow is, how do you extend the revenue cycle so it's not just a one and done, but you get your big lump up front and you maintain that relationship. Because that's a way that when you talk about the big swings in the cycle, if you still have that baseline, well, then all of a sudden you know what your floor would be. And I would think you're more attractive to private equity now.
No, I think it's very, very wise in a lot of ways. And I think that owners, um, the ones that we're talking to at least, usually the ones we talk to, just talked to a guy yesterday. He got a $30 million business, didn't know what the term EBITDA was, and that's common. Like that's actually pretty common. And so when you're throwing out these things, I think there's a lot more. Again, on Twitter, there's kind of this mythical world of everyone knows everything. You get into the real world, owners are trying to figure out what to do, and so something like you're saying there is, okay, well that actually makes sense. That's how I would do that, and so you can't always flesh out the one, two, three, four steps, but they do get calls, they do get solicitations. And the guy I'm thinking of, they build 700 to 900 new homes a year for one of the top. It's B2B. They're not even selling to consumers, so they got one of the top menu. And no, they can't get a look.
Mm-hmm.
No,
Mm-hmm.
it's a really good business. It's just funny to hear people go, no, I don't think so. And so I do wonder a decade from now if we're going to look back at someone who went anti-boring business Not tech, but anti-boring business, if you will. Took a little bit more risk and just absolutely crushed it because they swam against kind of that mentality.
Yeah, I mean, I completely agree. I mean, I think there will be. I think that that is more. I think that that's the type of opportunity more where you need the person that is not looking to build a portfolio of businesses and really is trying to double down on one. Because I mean, I think that guy who would ever buy that business is going to crush it. Is he going to have a few down years? Yes, but those up years are. I mean, he's going to be living high on the hog, so to speak. So again, I think it just comes back to like the primary negative about private equity investing just within the fund structure is just that it has that 10-year term. But I mean, believe me, I mean, construction is a way where I've tried to figure out how you can get into it because I completely get how lucrative it can be.
Okay. Where can we send people to learn more about what you guys are doing? You obviously you said you're looking right now for stuff. So where can we go? Twitter, website, where should we point people to?
Yeah, absolutely. I mean, I would say, three areas, website, Twitter, and YouTube. The website is fourpillarsinvestors.com, all spelled out. Twitter and YouTube, my handles or profiles are at Nick Four Pillars. So at NickFourPillars.
Awesome. We will link to all that in the show notes, which you can find at 5wide.biz. It was great to have you on, man. I know we're all over the map, but there's so it's there's just always so much to talk about when you get on these podcasts. So I
Oh,
appreciate the
yeah,
time.
no.
And it was great connecting with you and learning from you and look forward to following you as we continue on this great journey in the deal flow space, which I gotta say, I give people a hard time about it, but I really do love it. I really love the space
Oh,
that we're
yeah.
in. It's fantastic.
Oh,
There's
I love it.
always
I
something
love it.
going
I
on.
mean,
So,
even like forget about. I mean, as long as it makes me enough to put food on the table for my family. I mean, this is where I want to spend my career.
oh, absolutely. No, it's the best. It's the best. So thanks again for your time.
Thank you.